I, Neha Seth, am working as Associate Professor in Indira Gandhi National Open University, and today I am going to discuss with you this another topic under the series of financial management, that is dividend decisions. In the beginning of series, we have started with the functions of financial manager, and we have started with the very first function of financial manager, wherein a financial manager need to organize the funds, need to arrange the funds for the company. Okay, and these decisions were known as financing decisions. Another decision of financial manager was investing decisions or investment decisions, wherein a financial manager decides where to invest these funds. Okay. And the third and another important decision which a financial manager needs to take is dividend decisions. Once the company has accumulated profit, they have earned the profits, the financial manager will decide whether they are going to declare the dividend for this year or they are going to retain this profit and reinvest this profit for the growth of the company. So, our focus for today's session will be on the third and important decision which needs to be taken by a financial manager, that is dividend decisions. So, today we are going to introduce the concept of dividend decisions, and we are also going to discuss the models of dividend decision theory. These may be relevant and irrelevant models that we are going to discuss today. There are theories which are known as relevance theories of dividend model, which says that declaring dividend is relevant for valuation of firm. That means whether we are declaring dividend or not declaring dividend, it is going to impact the share price and then it is going to impact the value of the firm as well. On the other hand, there are models which says that dividend declaration or declaration of dividend is irrelevant whether you are declaring dividend or not declaring dividend. It is not going to impact the share price and ultimately it is not going to impact the value of the firm as such. So, we are going to discuss these topics under this particular heading today. So, let us start with the concept of dividend. Now, what is dividend? Basically, dividend is a portion of company's earning. Okay, these are the profits that a company has earned in one financial year, and the portion of those earnings which are distributed to the shareholders. Shareholders are considered as the owner of the company, and the portion of profit which is distributed among the shareholders of the company is called dividend. Why this amount, this figure is distributed among the shareholders? Because they have invested in our company. So, in a way, dividend is a kind of reward for the investment which is done by the shareholders in the company. We are giving them this amount, the dividend, in the form of reward to the shareholders. And the dividend is often distributed on a regular schedule, like every quarter, every semi-annually or annually, the dividend is declared on a regular schedule by the company. Now, what is dividend policy? So, dividend policy is something, or dividend decisions, dividend policy is something that involves balancing of shareholders' desired for current dividend and firm's need for funds for growth. Okay. So, basically when we are taking dividend decisions, we need to decide the amount that we are going to redistribute or distribute among the shareholders, or the amount that need to be retained, amount of profit. Of course, it may be possible that the company is going to retain 100% of the profit and it is going to reinvest for the purpose of growth, and it may also be possible that 100% profit that the company is earning may be distributed among the shareholders. Now, it depends upon number of factors that we are going to discuss further. Now, why dividend decisions are important? These are important because it helps in maximizing the present value of the firm. In the beginning only I have mentioned that dividend decisions may or may not impact the value of the firm, but yes, these decisions are important because it helps in maximizing the present value of the firm. It also helps in maximizing the wealth of shareholders, which is the ultimate aim of financial management. It helps in maintaining the liquidity for a firm to meet its obligation to government and debt holders. So, suppose a company is under some obligations to government or any other debt holders, then these kind of decisions are helpful in maintaining the liquidity and taking care of such obligations in future. These decisions are also helpful in providing returns to shareholders to maintain goodwill with the owners of the company. Owners are shareholders of the company. These decisions are helpful in deciding the proportion of earning to be distributed and to be retained back in the form of retained earnings. So, what proportion we are going to retain back, what proportion we are going to distribute among the shareholders. These decisions, these policies are helpful in deciding that proportion, that ratio as well. And also these decisions are helpful in distribution of profits annually or in interim period, or to give the bonus dividend. So, the kind of dividend, the time of dividend, okay, all these factors can also be decided, or the decisions may be taken when we are considering dividend decisions. Moving ahead to the factors that affect our dividend decisions. What are the factors that directly impact the decisions related to dividend declaration? The first one is availability of fund. So, the company, whether the company have enough funds with it or not, or what is the capacity of the firm to arrange the funds. Okay. If the company can easily arrange the funds through debt, because debt is considered as a cheaper source of finance as compared to equity. So, if the company is in capacity to arrange the funds, then yes, they may decide to declare cash dividend. But if it is difficult for the company to arrange the fund and they have to raise equity for arranging the fund, then they should think about it, whether they should declare the dividend at this moment or not. Then cost of capital. As I just now mentioned that debt is considered to be the cheaper source of finance as compared to equity. So, if the amount is available through debt, then we may decide, because in that case the cost of capital is less. But if we have to arrange the fund through other sources which are expensive as compared to debt, then we have to think about it. Then stock market reaction. So, if the company is in process, or the scenario is such that when the company is declaring dividend on the regular basis, so once the company decided not to declare the dividend, what will be the reaction of stock market? How the share prices of that particular company are going to react in the market? These factors also impact the dividend decisions. Then trend of the industry, the similar companies in the same industry, what is their trend? Are they declaring dividend? The percentage of dividend they are declaring. This is something also impacts the dividend decision of our company. Then legal constraint. If we have certain laws like company law has given the mandate wherein the dividend has to be declared through from the current profits only. So, if the company wants to declare the dividend from some previous profits or profits from the previous years, then they have to take special permission, or they have to get into these legal formalities. So, if there are certain legal constraints, then we have to abide to these constraints as well, and dividend decisions will be affected by those laws. Then shareholders' expectations. And so, our shareholders, what do they expect from us? So, if we are a growing company or a growth company, then our shareholders may not want us to declare the dividend, because the shareholders will also want us to reinvest our profits, so that the amount will be reinvested and the company will grow. So, ultimately the wealth will be passed on to the shareholders, and they will earn in the market in terms of capital gain from the shares that they are holding. But if the firm is declining firm, or I can say if it is a matured firm, then the shareholders are investing in these firms with the intention of getting regular dividend. Okay, from these firms the growth expectations are very less, but in terms of dividend the investment is made by the shareholder, so that they can get a regular income in the form of dividend. So, these are the factors that impact the dividend decisions of any company. Moving ahead with the models or the theories which are impacting dividend decisions, these may be relevance theory or irrelevance theory. Okay. When I say relevance theory, it has two models under relevance theory of dividend decisions, that is Walter's model and Gordon's model. And if we are talking about irrelevance theories, then also we have two models to be discussed here today, that is Modigliani and Miller hypothesis or residual theory of dividend. We are going to discuss these models one by one. So, when I say relevance theory or relevant models of dividend decision or dividend policy are those models which says that declaring dividend or dividend decisions are going to impact the share price in the market and also the value of the firm. Whereas irrelevant theory or irrelevant models of dividend policy says that whether the company is declaring dividend or not declaring dividend, it is not going to impact the value of firm at all. Now let us see these models one by one in detail. Starting with the Walters model, which is a relevant model for dividend decision. This model was given by Professor James E. Walter, and he argues that the choice of dividend policies almost always affect the value of the firm. So according to him, whether what policies we are choosing for dividend decisions, okay, these are mostly, in most of the cases, they are going to impact the value of the firm. So according to Walters model, dividend is relevant to market price of the share, and dividend decisions are taken on the basis of relationship between R and K, where R stands for rate of return the company is earning and K stands for overall cost of capital that the company is paying. So Walter model defines the relationship between R and K for the company and how this relationship is impacting the value of the firm. Okay, there are certain assumptions of Walters model. These assumptions says that there will be internal financing only. That means the company doesn't have access to external financing, like they cannot raise funds through debt or equity. So there will be only one source of financing for them, that is internal financing, or we may call it retained earning. So whatever they have in terms of finance, they can get it from retained earning only. And then return will remain constant and cost of capital will also remain constant. There will be 100% payout or 100% retention. So either company is going to pay out whatever they are earning altogether to the shareholders in the form of dividend, or if they are not deciding or they are not going to distribute the profit in form of dividend, they are going to retain that dividend 100% with them. Okay. Then there will be constant EPS and DIV. What is EPS? EPS is earning per share. So it will also remain constant, and dividend per share will also remain constant. And the timing will be infinite. That means the company's existence will be for longer duration or it will remain forever, that is for infinite period of time. Now keeping these assumptions in mind, this is something which Walter model says. So according to Walter's model, the market price per share is sum of the present value of two sources of income. So basically there are two sources of income when we are investing in the share, and the market price of the share is impacted by these two sources of income. The first one is the present value of infinite stream of constant dividends, which may be represented with this equation, that is DIV divided by K. DIV is dividend and which is divided by overall cost of capital, that is K here. And it also includes the present value of infinite stream of capital gains, and this may be represented with the help of the equation which is visible on the screen. With the help of these two equations, so there are two sources of two modes which are impacting the share price in the market, okay, and these two sources, that is the infinite stream of constant dividends and infinite stream of capital gains, when these two are clubbed together, we will get the equation for Walters model, or we may get the formula for Walters model, which is presented there on the screen, where P means the price of share is equal to dividend plus R, rate of return, divided by K, cost of capital. This amount has to be multiplied by EPS minus dividend that is distributed, and the whole amount will be divided by K to convert it into present value terms. Okay. So the same equation can be presented in another form as well, which is mentioned here. And there is one point that we need to remember, that DP ratio is dividend payout ratio plus retention ratio will always be equal to 1, because there are two ways the profit can be treated. Either we are going to retain the profit altogether, or we can distribute the profit altogether, or even the sum of this ratio will be 100% or equal to 1 always. So, if we decide to retain dividend, say 40% amount that we are deciding to retain out of profit, then the dividend payout ratio will be 60%. Suppose we decided to retain 25% profit, then the dividend payout ratio will be 75%. So, altogether it will be 100% always. So, in all, when it comes to, or we are trying to calculate this value in terms of ratio, the ratio of these, the sum of these two ratios will always be equal to 1. Okay. So, Walter model also defines or shows us that how firm changes, or there are certain conditions which defines that in what stage the company is, the firm is. Okay, depending, and it depends on certain factors, like in case of growth firm, okay, the R, the rate of return will always be more than cost of capital. That means whatever you are earning more than whatever you are paying in terms of cost of capital. So, your return is more than the cost that you are paying. So, in this case, that means when you are dealing with growth firm, in this case the optimal DP ratio should be 0. We should not pay dividend at all, or we should retain the maximum amount of dividend with us, so that this amount can be reinvested into the business and the company will grow with this amount or this investment. This is the situation where our dividend that is to be declared at the end of 1 year will be lower or almost negligible, and the price of the share will be higher. Then we have declining firms. These are the firms in which our rate of return is less than cost of capital. That means we are earning less than what we are paying in terms of cost. Okay. In this case, our dividend payout ratio can be 100%. So, in this case, since we are earning less, we are paying more cost of capital. So, we can choose this option wherein we can distribute our dividend to the shareholders. But in this case, the dividend that is declared at the end of first year will be very high and the price of the share will be very low. The third type of firm that we have is normal firm. This is the situation where our rate of return is equal to cost of capital, that is our R is equal to K. So, this is the situation where market price of the share is indifferent to DP ratio. So, this is the case, in first two situations we are dealing with the relevant model of dividend. Okay, dividend decisions. But if this is the case where R is equal to K and market price is not getting impacted by DP ratio or dividend payout ratio, then this becomes the case where dividend decisions are irrelevant for valuation of firm. Now, let us try and understand this Walters model with the help of one practical example. The question is there on the screen where EPS is given as rupees 10, our cost of capital is 10%. There are three cases scenario which is given here where our rate of return is 15%, 10% and 6%. So, there are three cases. Then our payout ratio, again the four cases are there. In case of payout ratio, when the payout ratio is 0%, payout ratio is 40%, 80% and 100%. We need to capture the effect of dividend policy on market price of the share using Walters model. Okay. So, in all we have to do calculation 12 times. How? Like when our rate of return is 15%, we have to check the value of share when the rate of return is 15% for 0% payout, 40% payout, 80% payout and 100% payout. Then for 10% again for all these payout ratios, then again for 6% of R and 4 payout ratios. So, this question can be presented in the form of table like this, which is visible on your screen, where on the top left hand side corner you can see that K is 10%, which is written as 0.10, and our EPS is rupees 10, which is common for all the 12 situations. But the situation or the cells represent individual Ks. Like for left hand side topmost cell, we can see that this is the case of growth firm where our R is greater than K. Okay. Our R is 15% and we have to calculate the share price for payout ratio. I am talking about the first column when the payout ratio is 0%, then when the payout ratio is 40%, when the payout ratio is 80% and when the payout ratio is 100%. So, let us first do the calculation for the very first cell on top left hand side corner. So this is our equation for Walters model, and by placing the values which are given in the question in this equation, we can do the calculation. So on the left hand side of the equation, we see it's written P, which is price of the share, which is equal to dividend, since in first case dividend declared or payout ratio is 0. So 0 divided by 10%, which is our K, plus 15% divided by 10%, which has to be multiplied by 10 minus 0. That means our EPS is 10, but our dividend declared is 0. So 10 minus 0, the value has to be divided by 10%. By solving this equation, we can see we will get the value of share price to be rupees 150. And now we can place this value, that is rupees 150, in the very first cell of our table. By following the same sequence, we have to do the calculation again and again for 12 times for different combinations of R's, K's and payout ratios that we have. Okay, and these are the values which we will get. So in the first column, where the R is greater than K, our return is more than our cost, we can say that when we are increasing the payout ratio, as we are increasing the payout ratio, we can clearly see the value of share, the price of share is falling. So when the payout ratio is 0%, our share price is 150, but when the payout ratio is 100%, the share price is 100 rupees. So from this we can clearly make out that in case of growth firm, when we are increasing the payout ratio, the value of share, the price of share will start falling. In the third column, which is the case of declining firm, or we can also call them matured firms, wherein R is less than K, that means our rate of return is less than cost of capital. So in this column, in the third column, when the payout ratio is 0%, the price of share is 60 rupees, and when the payout ratio is 40%, the price of share is 76 rupees. And when we are further increasing the payout ratio to be 100%, we can say the price of share has increased to rupees 100. So this is what we have learned theoretically, that in case of declining firm, when we are increasing the payout ratio, when we are distributing the dividend to the shareholders, so as we are increasing the payout ratio, the price of the share will also go up. Okay. So this is the case of declining firm. But in the middle column or the second column, we can see that this is the case where R is equal to K, our rate of return is equal to cost of capital. Okay. And we can see in this column the price of the share is same for all the 4 payout ratios. So whether the payout ratio is 0%, 40%, 80% or 100%, the share price is same, it is 100%, it is rupees 100 only. So it is not changing at all. So this is the situation where the dividend policy or dividend decisions are irrelevant, because whatever your payout ratio, whatever you want to distribute to your shareholders in terms of dividend, it is not going to impact the share price. Okay. So this is the conclusion of Walters model. So from this conclusion, from this table, we can say that yes, the Walters model is the relevant model for dividend decision, and it is not going and the dividend decisions are going to impacting actually the price of the share, and ultimately it is going to impact the value of the firm as well. Now the Walters model has certain criticism, they have faced certain criticisms as well. Okay. The first point under the criticism, or we can say these are the limitations of the Walters model. The first point of limitation is there is no external financing. So when such a situation exists, when we are not able to raise funds through external financing and we have to arrange the funds from internal sources only. So when such a situation exists, either the firm's investment or the dividend policy or both will become suboptimum. Okay. And then there is another limitation which says that constant return, which is of course not possible, that we have seen from our practical example as well. So when the R decreases as more investment is made, more and more investment is made. So the firm should decide to stop at a point where our R is equal to K, because they know when the R is decreasing, when R is more than K, our price of share was increasing when our payout ratio is less or reducing. But when R is equal to K, the the price of share will remain same. Okay, so we should stop at this point, because beyond this point, when our R is less than K, so when we are increasing the payout ratio, okay, then only the price of the share is increasing, otherwise the price of the share is decreasing. And then we have the third point, which says that constant cost of capital. Again, this is also one of the limitation, because it changes directly with the firm's risk. With this, we will take a small break and we will resume with another model of dividend policy in coming session. Thank you.